Luckily, most Americans don't know much more about bank failures than we all learn from watching the Christmastime classic It's a Wonderful Life with Jimmy Stewart. The U.S. has, after all, enjoyed a prosperous economy since the Depression era, and there are big protections in place for depositors. That wasn't the case then. So when a big bank failed in California just a few days ago, and given some uneasy rumors about others, there are worries in this era of mortgage meltdowns that there could perhaps be more on the way. We have this all covered tonight, and we begin with CNBC's Erin Burnett. She's here in our New York newsroom. Erin, good evening.
Good evening to you, Brian. And IndyMac is the bank which has failed. It's the second largest banking failure in American history. It is something that is putting more pressure on an already beleaguered industry. And I just came from the stock exchange, Brian, where the question isn't whether another bank will fail, but which one and when.
Monday morning couldn't come soon enough for depositors at IndyMac bank branches all over California. After a run on the bank last week, the government was stepping in, taking over the bank, offering depositors their money back. My colleague Jane Wells was at IndyMac when the doors opened in Pasadena, California.
They started lining up before dawn here to get into IndyMac Bank as soon as the doors opened so they could get their money out. There was some anger here, some fear, but mostly calm concern as people wanted to make sure their insured deposits were in fact safe. That is $100,000 for individuals, $250,000 for most retirement accounts. And they were hoping for more than the 50 cents on the dollar they've been promised on uninsured amounts above that.
Charles Tangari had his life savings in IndyMac, $236,000. He'll get back $100,000 plus half the rest, meaning he's out $68,000.
I'm never going to put anything over $100,000 again. Never.
The crisis at IndyMac was triggered by depositors concerned about the safety of their money in this economic storm. And other banks may be in trouble, too. If others fail, the burden would fall to the FDIC, and the numbers could get very large very quickly.
The FDIC is very healthy. They have almost $60 billion in reserves. But above that, you don't have to worry about the FDIC. They have an explicit guarantee from the U.S. government. So they're as good as the U.S. government.
The government has signaled it's ready to step in to reassure investors and depositors alike. Just this weekend, the Federal Reserve took action to shore up mortgage giants Freddie Mac and Fannie Mae. And the U.S. Treasury is asking Congress to increase their line of credit, making more money available in a pinch. And ultimately, who will foot the bill? The American taxpayer.
And certainly that's a big worry, Brian. But on Wall Street today, the bank that everyone was talking about was Washington Mutual. A lot of this is psychological, Brian, but Washington Mutual, it's one of the largest mortgage lenders. People are worried about the bank. The stock fell 35% just today. Right now, that stock price trading less than a gallon of gas when you look at the price. But a lot of this, again, is fear. And the company, Brian, put out a statement saying, we have plenty of liquidity. There are no problems here. It just goes to show you how fear can take over on Wall Street these days. Back to you.
Erin Burnett from CNBC starting us off in the newsroom tonight. Erin, thanks.